In just 2 days, nearly a quarter of Wall Street's value vanished, igniting a domino effect that would erase 89% of the market and haunt generations. Yet the truth behind history's deadliest stock market crashes is more unsettling than numbers alone reveal. What hidden forces kept repeating, transforming crises into catastrophe? The real story begins where the official narrative ends. Margin loans fueled Wall Street's fever in the late 1920s. By the autumn of 1929, more than $8.5 billion in borrowed money, greater than all the cash in the country, propped up the market's soaring prices. Investors, from small-town clerks to industrial tycoons, bought stocks with as little as 10% down, trusting the good times would last. But when prices slipped, brokers demanded repayment. Those unable to meet margin calls were forced to sell, pushing prices even lower in a relentless spiral. On October 28th and 29th, the Dow Jones lost nearly a quarter of its value. Panic spread as blue-chip giants like General Electric and US Steel plunged by half in a matter of days. Inside 23 Wall Street, JP Morgan's partners gathered, hoping to stem the rout with a support pool. But manual intervention could not halt the cascade. In just 3 years, the market lost 89% of its value. Recovery would not come for a full generation. 25 years of lost wealth, trust, and opportunity. Oil tankers sat idle as the Arab oil embargo took hold in October 1973. Led by Saudi oil minister Ahmed Zaki Yamani, OPEC cut shipments in response to Western support for Israel, and within weeks, the price of crude quadrupled. American factories and motorists alike faced shortages and soaring costs. The economy, which had been growing at over 7%, lurched into reverse. Inflation surged, reaching 12.3%, numbers not seen in a generation. On Wall Street, panic set in as profits evaporated and the cost of doing business climbed. The market unraveled slowly but relentlessly, with the S&P 500 losing nearly half its value over the next 21 months. Political turmoil deepened the crisis. Watergate headlines filled newspapers, and interest rates climbed as the Federal Reserve fought to control prices. Investors, battered by uncertainty and shrinking returns, retreated from stocks. Recovery would take nearly a decade, as the lessons of energy dependence and geopolitical risk reshaped American financial thinking. On October 19, 1987, the Dow Jones lost 22.6% of its value in a single trading day. As the opening bell rang, automated program trading systems began to unload billions in stock futures. These computers, following dynamic hedging strategies known as portfolio insurance, were designed by financial engineers like Hayne Leland and Mark Rubinstein. Their code was meant to limit losses by selling as prices fell. But when every machine sold at once, buyers vanished. The selling fed on itself. Prices collapsed, and order printers on the New York Stock Exchange lagged up to 40 minutes behind the chaos. By the close, $500 billion in market value had evaporated. The Securities and Exchange Commission's post-mortem confirmed that automated strategies had magnified the panic far beyond human control. In the aftermath, regulators introduced circuit breakers, automatic trading halts intended to prevent similar cascades. These new rules, adopted in early 1988, forced markets to pause when volatility spiked, forever changing how the system responds to sudden fear. Between 1995 and 2000, technology stocks soared more than 400%, fueled by a new kind of optimism. Investors, from college students to seasoned executives, poured savings into dot-com startups with little more than a website and a dream. The Nasdaq's price-to-earnings ratio climbed near 200, a level that defied all historical precedent. Analysts at major banks issued glowing reports, even as internal emails revealed private doubts about the sustainability of these valuations. Pets.com, Webvan, and dozens of other companies went public without profits, or, in some cases, even revenues. The story was simple. The internet would change everything, and traditional business rules no longer applied. As the narrative took hold, retail investors became convinced that missing out was riskier than buying in. When the bubble burst in March 2000, the Nasdaq began a relentless slide, losing 78% of its value by October 2002. The recovery would take 15 years, leaving a generation of investors wary of hype and headlines over hard numbers. Mortgage brokers wrote loans to anyone with a pulse, bundling risky debts into complex securities that few understood. Inside the glass towers of Wall Street, investment banks like Lehman Brothers borrowed up to $30 for every dollar of their own. These debts were sliced and stacked into mortgage-backed collateralized debt obligations, stamped with AAA ratings and sold around the world. When home prices began to fall, the weakest borrowers defaulted first. The value of mortgage-backed securities collapsed, and banks faced mounting losses. Short-term funding markets froze as repo counterparties refused to lend, fearing hidden risks. On September 15, 2008, Lehman Brothers filed for bankruptcy after failing to secure a lifeline. The shock rippled through the global financial system. The S&P 500 plunged 57% over the next 17 months. On September 29th, the Dow fell 777 points in a single day, its largest drop ever at the time. Policymakers hesitated, and the credit system seized. It would take 6 years for markets to recover, leaving millions out of work and millions more facing foreclosure. The hidden leverage and tangled web of obligations had brought the world's financial system to the brink. On February 19, 2020, the S&P 500 reached an all-time high. Within weeks, cities emptied and businesses shuttered as the world responded to the COVID-19 pandemic. In just 1 month, the market plunged 34%, its fastest descent on record. By April, over 20 million Americans had lost their jobs, a shock not seen since the Great Depression. Fear rippled through every sector, from airlines to restaurants, as investors scrambled to make sense of the chaos. Then, in a matter of days, the federal government unleashed a response without precedent. Congress passed the CARES Act, pouring $2.2 trillion into the economy through direct payments, expanded unemployment, and small business loans. At the same time, the Federal Reserve cut interest rates to 0% and announced unlimited quantitative easing, promising to buy as many Treasury and mortgage-backed securities as needed to restore confidence. The Fed's balance sheet ballooned by more than $3 trillion in a matter of months. By late March, the panic selling slowed. As trillions in stimulus reached households and businesses, the market began to climb. By August, the S&P 500 had erased all its losses, reaching new highs just 8 months after the crash began. Never before had policy moved so quickly or with such force, compressing a cycle of fear and recovery that once took years into a matter of weeks. Every major market crash has left a trail of warning signals. The first is excessive leverage, when investors or firms borrow heavily to amplify gains, because even a small downturn can trigger forced selling and a downward spiral. Next comes over-concentration, where too much money crowds into a single sector, asset, or idea, leaving portfolios exposed when fortunes reverse. A third red flag is rapid price gains that far outpace underlying earnings or economic growth, signaling that speculation, not fundamentals, is driving valuations. The fourth is the rise of complex or poorly understood financial products, tools that promise protection or easy profit, but can fail spectacularly under stress. Finally, Fragile market plumbing, such as automated trading systems or shadow banking channels, can turn routine volatility into systemic chaos. Recognizing these 5 signals is the first step in protecting capital when euphoria takes hold. 2 habits have protected investors across every crisis. The first is discipline. Avoid leverage and speculation, no matter how tempting the rally. History shows that borrowed money magnifies losses and can force sales at the worst possible moment. Behavioral finance studies confirm that those who chase quick gains with borrowed funds are far more likely to panic and lock in losses. The second habit is patience. Data from every major crash reveals that panic selling, when investors sell out of fear as prices fall, almost always leads to missing the recovery. Investors who held steady or even added to their positions when fear was highest recovered faster and built more wealth over time. The speed and strength of policy responses, from circuit breakers to massive stimulus, have shortened recoveries, but the core principle remains. Markets rebound, but only for those who stay invested. As one behavioral economist puts it, discipline and patience are the investor's best defense. Today, markets move at the speed of algorithms, but human behavior still drives every high and crash. As global debt and speculation reach new records, the next shock is not a question of if, but when. History doesn't repeat, but it always leaves warnings. What will we do differently?